Hello and welcome to Mississauga Life and Real Estate Podcast. This is Sean Jaffrey, joined by my co-host, Alex Stakic. Alex, how are you doing today?
Hi, Sean. I'm very good. Thank you very much for inviting me once again on our amazing Mississauga Life and Real Estate Podcast. And I am happy that we're covering very hot topics today. So let's move on.
Oh, man, let me tell you. I mean, you and I talked about this briefly, and some of this stuff really got me fired up because we work with people all the time, and we kind of see, the joys of it, the pain of it. At the end of the day, you just want what's best for your clients, and you wish that the situation was a bit better than we've seen in the last little while. But anyways, let's get into the details here. We're going to talk about new home sales and kind of talk about why, that might be an issue for the real estate market a couple of years down the road. We'll talk about Consumer Confidence Index. Mm-hmm. We will touch base upon, the house price to income ratio. Where does Canada stand compared to the rest of the developed countries in the world? Mm-hmm. Maybe some possible fixes. Let's discuss, what are some of the possible options that can kind of help, create the type of real estate market where people, families, good, hardworking people can live and thrive in. And not have to, put up with all this BS we've been putting up with for the last couple of years. So let's get started. Let's first talk about the new home sales. Mm-hmm. Okay, so in September, this past September, it's no secret the market's, resale market we talked about last week was down 44%. But in terms of new sales, they're hit even harder, right? Yeah. So Toronto new home sales are at the lowest levels they've been in the last 20 years. Yeah. At the peak, so this is the peak of 2020 September, there were about 2,400 sales for new single-family homes. We're not talking about condos. We're talking about detached semis, townhomes, that sort of thing. So 2,400 in Toronto, September of 2020, which was the peak. This past September, different story. There were less than 200 sales in September. That's quite a drop.
Yes, it's 12 times less. And if you remember, in 2020 September, we were in the peak of the COVID time. So yes, it's even worse what's going on, man, that we have the 2 years when we are out of COVID, right? We have only 200 new sales in Toronto. Yeah. And how many people we have in Toronto? 7 million. So it's close to nothing.
It's interesting because there's a lot of similarities in terms of home sales, in terms of, credit card defaults, stuff like that. That's very similar to the pandemic time, but we're not in the pandemic anymore. And, this is the new reality. Now, similar to new home sales in Toronto for new single-family homes, let's talk about condo sales. Yeah. Again, the lowest in 20 years. 2020 peak, Alex, in September, 2,700 condo sales, right? Yeah. This past September, 250 condo sales in all of Toronto in the month of September.
Yeah, it means, again, 10 times less comparing to years before. And if we consider that this year, including yesterday, we had 6 consecutive increases of the mortgage rates. Right. What you really expect, other than people were talking about prices, affordability, mortgage rates, and what is their solution to move forward or to step out, right? So I'm not surprised. Yeah. And with yesterday 0.5%, I'm pretty sure that this trend will go furthermore, that we'll have even less transactions. Maybe I'm wrong. If you remember on our last podcast, we discussed that in Q3 we had 300,000 new immigrants. Maybe that force immigrants who came, some of them with the money, maybe they will keep these numbers in these 200s. But how many of them and how long? So we have to keep that in mind as well.
Yeah, I agree. One thing that I was thinking about, Alex, was that, look, resale, sales were still happening. Closings were still happening. If you look at September, yes, we were down 44% compared to the year before. Yes. But, there were still sales happening, but when it comes to new construction, we're down to like 10% of where we were the year before. And the main reason for that is when it comes to resale, people have adjusted prices according to what the market is doing. However, when it comes to pre-construction or new home sales, the builders can't drop their prices. You know, they've already factored in the cost of the rising labor, the cost of rising, the supply chain issues that are adding to the cost. So a builder who was selling, like a townhome in Vaughan, for example, new construction for $1.5 million, today they're still sitting at that price. They haven't dropped their price down. I mean, if anything, we've seen certain incentives with these sort of purchases where, you get like a Tesla lease for 2 years or something crazy like that, but the prices haven't come down. And I think that's one of the reasons why the sales have dropped the way they have in the new sales market.
Yes, absolutely. I agree with you. And, even if they try to do so, they're already under contract with the client. They cannot reduce price for new ones. They have only option to give incentives. And again, there is some bottom line. When even incentives will not work out anymore because they cannot return their substance they put in to build these homes. And moreover, even if they can, the prices of the land is going up constantly. They will not be able to go to next circle of investing to buy new land with the new prices.
Because they've already purchased the land.
Of course. So, this is something they cannot avoid, and this is on the bottom line.
I mean, this, I'll be honest with you, this is a podcast topic on its own. We can talk about so much more detail because the application process to get land and then purchasing the land with borrowed money and the interest costs on that. And then, the permits coming in after 5 years. And then you finally start. I mean, this is a whole different topic that you and I can talk about in another podcast. But anyways, the fact is that this is the reason why sales are down so much is because, the builders don't have any wiggle room. They can't really drop their prices. This is not like resale real estate. This is totally different. Absolutely. Okay, let's talk about Consumer Confidence Index. So Bloomberg Nanos, I believe, released this report showing us that the Consumer Confidence Index for Canada, I don't know what the other countries were like, but it's the lowest level since the pandemic. It's on a downward trend as far as we can see for the last couple of months. Now, one thing, Alex, that completely blew my mind, and I gotta be honest with you, this was I had heard of it, but I didn't know that the spread was so big. There is something called the house price to income ratio. And this is basically a system of just measuring, what portion of your income is going towards, your home, to your living expenses. And then you're graded on that, right? So the lower score you have, the better it is.
Of course.
So, we're looking at the OECD countries to compare to Canada. Canada's an OECD country. We have Japan, the US, Germany, Italy, Australia, UK, France in the running. And when we compare ourselves to these countries, I mean, let me just give you an example. Okay, Japan, right? So Japan on this scale is at 80 points, which is the best out of all the OECD countries, which is great. Then you have the US, Germany, and Italy that are about 120 points on this grading system. So, not as good as Japan, but it's still good. Australia, UK, and France at 175 points. Canada is at 220 points.
Wow,
which is bad, right? That's like you're getting a D, if not an F, on this report card, right?
Yes.
This is insane. I mean, why is there such a big discrepancy? USA takes immigrants just like Canada does, but they're at 120 points. Why are we almost double? In terms of house price to income ratio? This is just mind-boggling for me. Anyways,
you're
Housing
right.
Affordability Index is crazy. We've gone from 30% historically to 50%. So 50% of the average Canadian is paying 50% of their income in household expenses. Is that not crazy?
Absolutely, right? In my opinion, unacceptable. And we have to see what is the root of this problem. If we had a chance to discuss, for example, with the people who were purchasing their properties and living here in 60s and 70s or 20th century, they're saying, we had very nice, beautiful life in Canada. I was working on my own. My wife was housewife. She was
a housewife,
looking after my kids. Today it's impossible. So that means that the living standard is going down. And this is one of the good numbers showing that actually standard is going down. Comparing U.S., we are 250 you mentioned, and they're 125, right? It's almost double. So
we're at 220. They're at 120.
Yeah. So the question is where we are going to. Can we stop that? Can we reverse that? And what is the cause of the problem?
Yeah. Well, let's get into it. A couple of things to note, or one thing to note is that, you'll often hear mortgage brokers talk about how ideally your mortgage payment should be about 20 to 25% of what your income is.
Yes.
Right?
Maximum, maximum, I think it's 30%, but it's max of the max.
Yeah. So if you're making, let's just say $4,000 a month, your mortgage payment needs to be like $1,000. I don't know anybody with $1,000 mortgage payment. It's 50% now, which is insane. So, I've been looking at a couple of different articles, Alex. There's three things that were kind of tossed around in terms of what's the solution to the problem we're having with housing affordability. Right? It's very, very bad. It's dire. So one solution was rates must come down. Right? So mortgage rates come down and people are able to afford housing again. But there's a problem with that, isn't there?
Yeah, of course. Prices will again go up.
Prices will again go up because there's not enough homes.
Supply, yeah. We have a problem with the supply.
Yeah. So rates must come down by itself. I think it's not good enough.
No.
Second is prices continue to go down. So rates stay high, and over time prices continue to go down. The problem that I see with that is that, more and more people then turn towards renting. And then when the rental supply runs out and the prices or the rents go up, then you're left with this dilemma. Like, should I pay this crazy amount for rent or should I just end up purchasing? Right? Right now, the average home is being rented for over $3,000 a month. I mean, we're talking about townhouses here.
Yes. This is what I wanted to discuss with you today about. So I discussed yesterday with one mortgage broker, and we just tackled that topic that I assume in USA is not such scenario like here, that if you are paying your rent $3,000 a month plus utilities, we are coming to $3,500 plus insurance plus, right?
Yep.
So if you can consistently pay $3,500 a month, that equals XYZ mortgage. But when you go to the bank, they don't see you as a qualified client who can buy any property in spite of the fact you're paying $3,500 a month. That $3,500 a month maybe can replace $600 mortgage, right? But these people are out of the picture. I believe that in USA it's quite a different story, and maybe we should think how to give some incentives to these kinds of clients. Because they really end up.
Yeah, I think what you're talking about is easily doable. And I think that the problem we're having, a big chunk of it is that there seems to be a disconnect. It's like, the different levels of the government aren't working together on this issue. I don't know what government policy is like in other parts of my life, to be honest with you, when it comes to healthcare and other things. But as far as real estate goes, it feels like there's a real disconnect between what the different levels of the government are doing, because this is a problem that I think is easily solvable because we're the only ones who seem to be having it in the world, or at least in the developed countries.
Yeah.
Another option is that another solution to the problem that we're having with affordability is that prices flatline while income catches up. So basically, the prices stay where they are, and then over time, all of us start making more money. And then we can afford, housing affordability index gets better. Again, the same problem. If we don't build more houses, the solution doesn't work. Right?
Absolutely.
So I've got a solution, Alex. Tell me what you think of this, okay? Build more houses along with reducing the interest rates. What do you think of that? Is that crazy?
It will be the best possible solution because it's very simple economics, because if you have very fixed supply and
economics
you have
101.
and over increased demand, and demand is because people are coming to the country. And I think in last to last podcast we discussed that in the last 12 months, 700 people came to Canada. So this human force needs accommodation, and if we still have not matching numbers in the new homes, demand is going up. They cannot be qualified right now for the mortgage, and that will affect with the insanely increase and bidding wars for the rentals, right? So who is winning in this case? Investors who have cash money right now. They have enough to invest in new properties, resale properties, rent them for heavy rents and move forward, right? They will get discounted prices for the properties right now. They will rent
if they buy
for
cash.
Whatever, right? Or
Right.
they qualify for the mortgage, right? At least they have their numbers. So you will buy properties for discount price. You will rent properties for more than average rental because it's huge demand for the rental market. And these kind of people are in the win-win situation. Who will be losing? Question is, who will be losing? The rest of us.
Well,
right?
I mean, the working class, like the average person, the average family of four who, the mother and father are working, and they're too busy to do anything else. They're the ones who are missing out. They're the ones who are at a disadvantage right now. And I think the time has come, to be honest with you. I mean, if you've never been politically involved, you need to get politically involved. You need to reach out to your MP or whoever the representatives are and get them, let them know that this is an issue. We are getting upset because, fine, we may suffer a little bit right now, but it just seems to be getting worse. What's going to happen with our kids? What's going to happen when our kids in 10, 15 years' time are old enough to get married and have their own families? Are we looking at a lineage of renters from this point on? This is a scary, scary thought.
Right? I agree with you. And Sean, I don't know if we had a chance to discuss with your clients, but I have a couple of them, and I noticed when I'm discussing about down payment, I'm asking them where down payment is coming from. And in more and more cases, first-time home buyers are getting a portion of down payment from their fathers, mothers, and close families because they cannot afford to save on their own. They're in mid of 30s. They still don't have enough saving for down payment for the starter condo. So more and more involvements of the family members, close family members, are comparing maybe 3-4 years ago. What is your call about that?
I've seen both sides of it. I've seen people who are, in their early to mid 30s, professionals, and given the cost of living, even though they're renting, it's very hard to save up, $70,000-$80,000 for a down payment for a starter home in the Greater Toronto area without making crazy sacrifices. Maybe, I don't really want to get into that. That it just gets dark from there. And then I've seen people who, who've been in Canada for a year. They just got their PR and they're ready to go. They're ready to purchase. This is definitely money that's coming in, generational wealth or something that they brought with them when they came to Canada. Yeah. But for the average family, to save $80,000 will probably take 5 to 6 years, or if not more. And by that time, the prices would have shot up again. So it's a tough situation. So you were talking about population growth, right? Yeah. Population growth. So it's crazy because, Alex, as far as I can remember, at least the last 10 years in real estate that I've been in, we've always had a very, very active and busy market. We've never had a depressed market. Now, I can't remember a depressed market where homes were just sitting on the market and there were no buyers. We've always had that situation. And then, we did build, you and I were doing business here on the west side of Toronto, Mississauga, Milton, Oakville area. So we know that there's tons of land on the Milton side. There's many spaces to be built in, Oakville North. Mississauga is pretty much built out, but there's some spots of lands there as well. We're not building, but we're bringing in people, like you mentioned, 700,000 people Canada this year. I think it's just as aggressive next year. 500,000 is a target, I believe. The situation is not going to get better unless there's more inventory. The way things are going right now, even though the rates are high, the second the rates start to come down and the market starts to stabilize and people get back into the market, we're going to be back at square one, is what I'm looking at.
Yeah, you're right, because we have lack of inventory, and nothing will change if we don't have more supply, condos, townhouses, whatever. And I believe because of lack of land, policy will be to intensively build condos because we have limited land source right now. This is my view. Maybe I'm not in this high level of planning or city planning. I don't have idea, but yeah, I think logically.
Yeah, I think naturally, wherever the government feels like they make the most amount of money in taxes, that's what they're going to issue permits for, whether it's condos or townhouses or detaches or whatever it is. Whoever's listening to this podcast, please get out there, talk to your local MP, get politically involved, let people know that this is a situation that needs to be addressed today so we can have something for our future generations. So another thing to note, Alex, and, I'm not trying to be the party pooper here or anything by any means, but these are things we need to keep an eye on, right? Yeah. You and I both know sometimes you have a buyer you're working with, and they feel like they've gotten a pre-approval. They get into the whole offer situation. They get a property, and then turns out that they're going to have to turn towards a B lender because something popped up from their past history that they weren't anticipating. Yeah, unpaid bill or whatever it is, and the conventional mortgage coming from a typical bank like RBC or Bank of Montreal is not going to work. So they have to turn towards B lenders. And that's another part of the industry that nobody really talks about, but it's very, very active, right? I mean, there's a lot of people, especially when you talk about self-employed people, that end up using B lenders. And, the thing of note right now is that, the report that I read said that on average, they're at 8% for the interest, but I've heard higher. I've heard 10%. For some people who got a mortgage for 2 years, a 10% interest rate for 2 years. So this is actually the highest. But the reason why we're talking about it right now, the reason why I'm talking about it right now, this is the highest it's been since 2008. It's 8% on average. And that could point towards, tougher times, because when the Bank of Canada rates go up, these B lending rates go up as well.
Of course.
Right?
Absolutely.
So that's something to watch out for. One last thing, which is kind of something to kind of keep an eye on, is credit card delinquencies. So credit card delinquencies in Canada have, historically they've been low. There was a bit of an uptick during the COVID times, but that's understandable, right? People were working and they were relying on credit cards. Yeah. But we're back to an upward trend. So January this year, in 2022, we were at 1.3% for delinquencies, but it seems that ever since last month, or maybe 2 months ago, the trend has started to go back up. So we're going back up from 1.3 to a little bit higher. So it's nothing to be concerned about right now. The reason why we're talking about it is because the trend is upwards. And if it keeps going upwards, then that's sort of like a canary in a coal mine situation.
Yes, that means that people do not have liquidity. Correct. And that liquidity is first affected with the credit cards. You try to find shortcuts and easy solutions, but in this case, most expensive. And we have to ask ourselves, if this credit cards ratio is increasing, what has happened with the equity people are having in their properties? Because taking equity money is cheaper than taking credit card money. Right. So maybe they're also thin on their equity.
They're thin on the equity. Makes sense.
Yeah, and when time comes for renewal of the mortgage, I think it will be a very tough time.
Yeah. And at the same time, you can also kind of hint towards the fact that if credit card delinquencies start to go up, which means that people may have not paid their credit card bill because just the cost of everything has gone up and they're not, they don't have the money to do that. The next thing's going to be probably the mortgage. Or if they are paying their mortgages, but their credit card delinquencies keep going up, they're missing their credit card payments regularly, then the credit card companies are going to come after the house.
Absolutely.
I mean, that's typically the way it goes. They go after your assets.
Yeah, of course.
Another thing to point out is consumer insolvencies. So this is something important too, because 2013, we were at about 120,000 consumer insolvency. Basically, what this is people kind of filing for consumer protection or bankruptcy, one of those two things.
Yeah.
In 2013, we were at 120,000. 2020, we're at 140,000. 2020 is when we had, it was pandemic had just started at that point. 2022, consumer insolvencies were at 80K. So far, we've been at 80K. And I think the part of that, Alex, has to do with the fact that, property values went up like crazy, right? So if in 2022, from 2020 to 22, we were at 80,000 consumer insolvencies, which are lower than 120K average. It's because the house prices went up and people had way more equity that they could use, to pay their debts and service bad debt. But now we're back to 100,000 insolvencies. And this is it's an upward trend. So there's something to keep an eye on, right? If it keeps going up, you do the math, right? So right now it's just 1 month stats. So we should be okay. But, obviously we'll keep you posted, right? This is what we're doing. We're making sure that everybody's aware of what's going on around them.
Yes, we will follow all these KPIs and give our opinion about that, because this is very, very important what you mentioned. This is only first month. I would like to see what will be the same number, same KPI, for example, in February or March or even April. I'm pretty sure banks know much better than you and me right now what is a trend and what will be outcome in a couple of next months, especially if mortgage rates will stay steady on same level, or as it mentioned, maybe they will be increased again. Then I'm pretty sure market will slow down even further and prices will go even more down.
Yeah, I think so too. I mean, this is a bit anecdotal, Alex. I was talking to one of my clients who works for one of the big banks, and she was telling me that there's a lot more people coming into the branches these days, kind of doing the refinancing thing to take some money out to pay their bills, etc. And I asked her if she had any official numbers, like is it like 10% of your customers that are refinancing, 20%? And she said that I don't know what the exact number is, but it's probably 3 times as higher as it is most of the time. So you have a lot of people now coming in to refinance just so they can have more money to kind of carry them over until the next couple of months. So who knows where it's going to head it, but obviously high interest rates are hurting everybody. I think the key thing to take away, if there were any takeaways today, number one, let's kind of focus as Canadians for our next generation. Let's focus our attention on more supply, whatever that takes, whether it means, reaching out to your local politician, or you start talking about in your circle of friends and family that we need more supply. Let's get active on them. Let's do that. And number two, tighten your belts, because times are hard for everybody. So it's going to go all around, right? I mean, if consumers are having a hard time, they're spending less money, it's going to hurt everybody. So let's be vigilant and let's be smart.
Absolutely.
I think tough times are ahead.
I agree absolutely with you. And in the next few months, probably to spring, we will see what will be real developing story upon all this, what we mentioned today.
Yeah. I did notice that a lot of people, and maybe it's just me, but I noticed that a lot of buyers, a lot of sellers actually, put their house up on the market to sell. They didn't get the price that they wanted, and then they took them off the market. And I think they're going to plan to sell them again when, the spring market comes up. Because I think for a lot of people right now, the idea is this is a very short-lived thing that we're going through. Then in a couple of months, things will kind of come back to normal and prices will start going up. So, I'm interested in seeing as well what's going to happen come this next spring market.
I agree with you. Let's see.
Awesome.
Who knows?
Let's see. Awesome. Thank you so much, Alex, as always, for joining. Good conversations, and we'll see you guys all in the next podcast.
Thank you, Sean, for the invitation. See you next week.
Take care.
Bye-bye.